today's panel, I'm happy to introduce Joseph Endres from Hodgson Russ in Buffalo, New York City, and some other cities. He is an expert on state and local taxation. Our good friend Karen Tenenbaum, Esquire, from Long Island, who is also an expert on state and local issues and, of course, enforcement issues with our friends at the New York State Department of Taxation and Finance. Sal Candela, enrolled agent from Queens, Middle Village. Middle Village?
Close enough.
Close enough, someplace in Queens. And Shelley Jacobson Taylor, EA, CPA from Manhattan and Pennsylvania, a good friend and also an expert on enforcement issues. If you have any questions, you can see to the right of the chat tab is the Q&A tab. If you would put your questions in there, it does two things for the panelists. First, everyone doesn't have to type in their question. If you see your question, you can click upvote. That'll let us know how many people are interested in that question. It will also move that question towards the top so that the questions that most people want to hear will get asked as soon as possible or at least first. And we plan to answer everybody's questions. So everybody want to take a quick 30 seconds to say hello, or did I cover it? Joe?
Nope, I'm ready to get going.
Okay, Sal?
Yeah, let's move this thing on.
Okay, so I want to talk first. The most important thing is what New York State has had a position for the last 30 years, maybe, that they have, of course, enforced by examination and then subsequently by going through the appeals and even the court process, where New York takes the position on sourcing that if it's a New York job, it should be taxed to New York. Joe, you want to take that for me, talk about that a little bit?
Sure. So it's known as, it's completely misnamed because it's known as the convenience rule, but it's anything but convenient to people that are subject to it. And, prior to the pandemic, it was somewhat of a circumscribed issue because not many states had it. New York wasn't alone in this respect. Six states had a convenience of the employer test, including Connecticut, New York, Pennsylvania, Nebraska, and 6 total. But so it was kind of circumscribed. It wasn't a national issue. It was just for people that were working for employers in those states. Well, fast forward to the pandemic, and suddenly this issue just absolutely explodes because now everybody's working from home, right? That's the big change. I mean, you mentioned that I'm here in Buffalo today, but prior to the pandemic, I would work more out of our New York City office than I would our Buffalo office, but I haven't been there since February of 2020. Well, a lot of people are in that position except they're now crossing state lines. People that work for a New York employer, but living in Connecticut or Jersey or wherever, now working from home. Well, in response to the pandemic, a whole bunch of states have decided they've had to weigh in on this issue, right? A whole bunch of states had to say, okay, well, now everybody's working in different places. How are we going to treat that? How are we going to treat that for personal income tax purposes, which is really what New York's convenience rule is primarily geared at? But then beyond that, how are we going to treat it for withholding obligations? Where does the business withhold? How does that impact a business's nexus situation? In other words, if I have an employee now working from home in Connecticut, I'm a New York employer. I've never had any presence in Connecticut previously, but now suddenly I do. Do I have to pay income tax to Connecticut? What creates nexus issues. So it's an issue that has completely exploded. I want to get some of my co-panelists in here to get their comments on it, but I'm seeing this as probably the #1 issue in state tax now.
So I want to jump in. So you really have to put this in context. Why are we even talking about this? This is all about residency issues for income tax purposes or for even estate tax purposes. So New York State taxes you on everything that you earn if you're domiciled here or taxed as a resident. So we're not going to go through all the residency and domicile rules, but now we're talking about allocation of income, New York source income. So what happens if you're a New York State non-resident and you were always working in New York? You were taxed in New York, and now New York is saying through their FAQs, they don't call it convenience versus necessity, but they very clearly say, if you are a resident of New York, a non-resident of New York State, whose primary office is in New York State, your days telecommuting during the pandemic are considered days worked in the state, unless your employer has established a bona fide employer office at your telecommuting location. So again, they don't call it convenience versus necessity, but they're saying basically nothing has changed.
Correct.
So
And the big case on that, and a big case that needs to be looked on that is the Phillips case, in which again somebody set up in Pennsylvania. I think it was a trader working for Lehman Brothers, if memory serves me correctly. Okay, but they set him up in his home, fax machine, so on and so forth, and specifically said that because he was in charge of worldwide trading, that time-wise, it just didn't work for them, and still he lost that case. I know it was a 2000 case. I know that he lost it on appeal, and I believe it's going onward. I don't think they've given up on it yet, but I know that the Phillips case is one of the ones that, again, just is shocking in doing so. So, yeah, it's a very big issue.
So unlike some of the other states, though, let me just throw one thing out here. Unlike some of the other states that this year, because of the pandemic, woke up and said, ooh, we need to protect revenue or we're going to have a budget shortfall, New York has had this rule for how long?
Oh, years and years. I mean,
30, right? The 80s.
Yeah. I mean, it's been around long enough so that it's actually been litigated all the way through the courts and deemed to be constitutional at every level. So it's not going anywhere. Well, I should say it's not going anywhere in New York. It'll be interesting to see whether or not the Supreme Court decides to take up the issue and weigh in on it. They did not previously when it was just a New York issue, but now it's a national issue. Now, let me just give you, I know we have people coming in from all over the country. In response to the pandemic, the following states have essentially adopted, at least temporarily, a convenience rule. Alabama, Arkansas, Connecticut, Delaware, Georgia, Maine, Massachusetts, Mississippi, Nebraska, New Jersey, New York, Ohio, Pennsylvania, Rhode Island, and South Carolina. So before, when I said this issue started out as a 6-state issue, it's now ballooned to be an 18-state issue, and it's a national issue. You have states now fighting over it, like Massachusetts versus New Hampshire.
So we're talking about other states and non-residents. Let's talk about someone who had an apartment in New York City and worked in New York City and were clearly a resident of New York City and New York State. And now, because of the pandemic, let's say in March, they said, you know what? I don't have to be in New York City. The office is closed. I'm going to work out of my house in the Hamptons. And so what's happening there? So in March, they move out to the Hamptons. And then in September, when their lease is up, they say, you know what? I'm giving up the lease. I could work from my living room. Yep. My boss is fine with that. And so they give up their apartment. We had Joe Carzo, head of audit, on a panel for the tax symposium a few months ago. And we said, when did this person move? Because New York City is still going to claim that they're a New York City resident. They're clearly a New York State resident. That's not the issue. And when did they change their domicile? They have the burden by clear and convincing evidence. But when was it? Was it March when they first moved, or September when they gave up the lease? And of course, Joe says it's a facts and circumstances situation. It depends on what their subjective intent was. When they moved in March, did they intend to move forever, or was that in September? And how do you prove that? You have to show objective things. And those are the 5 primary factors. And then the taxpayer has the burden of proof by clear and convincing evidence. So it's going to be interesting to see what happens.
And Karen, you make a valid point. In that particular case, and let's be factual about this, okay? Chances are that nobody in March thought that a year later we'd still be talking about it, right? Again, and again, just hypothetically, because I don't want to get your client in trouble already. But chances are that in reality, they probably thought that this would be done in 2 months, right? And they'll be back, right? This is the problem. And it is the same problem that we're all going to have with our clients, that they're going to look at this and say, oh, no, I meant to move in March, when we actually probably know in our hearts of hearts that that's probably not correct, because in March, we all thought that this was going to be over with in just a matter of maybe a month or two, right? Nobody thought that a year later we'd still be having this conversation. And I think that is the crux of what's going to happen with our clients, is that in retrospect, they're going to be going, oh, yes, in March, I decided I was never coming back, and it took me 9 months to sell my apartment. And I think that's going to be the reality of what's happening out there.
You know,
New York State is going to have the benefit of hindsight, because let's say you do come back 2 years later, right? So this is what took place in 2020, what took place in 2021. You're going to file your tax return whenever, and then a year later they're going to audit it. And so they're going to see what you actually did with your children, where did they go to school, where did you move back, etc.
I have a very large tax return in the city, and I don't just do representation. I do a lot of tax returns, and I can't tell you how many emails we as an office have gotten as I left the city in March. I haven't come back. I'm not a New York City resident anymore. And then we have to explain to them the issue of domicile versus, statutory resident, and the fact that because if the pandemic happened mid-January, they might have a chance if they didn't step back into New York for the whole year. But because it happened in mid-March and they failed the 30-day rule, there's no way they're a non-resident of New York City if they haven't made a clear and compelling case that they abandoned their domicile, and nobody wants to hear that. And I mean, there's also the issue of not everyone went to New York State. Some people went to New Jersey to their storehouse. Some people went to Pennsylvania. We're going to have the issue of the two states. If they went to Connecticut and they're a statutory resident of New York, and if they're a domicile of New York and a statutory resident of Connecticut, they're going to have income that's double taxed with no corresponding credit, because Connecticut will give you a credit for the work income in two places, but it will not give you a credit for the unearned income carried in, interest, dividend, capital gains. So that's going to be, nobody wants to pay tax once, let alone twice, and that's
been deemed constitutional.
Yes, and Shelby hit it on the head. How many of our clients, and again, Karen, you talked about New York to Hamptons. How many of our clients hightailed it out to Pennsylvania, to Connecticut? And they are looking at this now, looking at this from the standpoint of, you're telling me that I'm paying tax in two states as a resident? That can't be. That you got to be wrong about that, right? And it's just a fact of life. It's going to be one of those years in which we're going to be repeating ourselves to our clients over and over again. That is the law.
Do you remember the Rosie O'Donnell show? She used to have buttons on her desk where
yes.
she would play. We need that for our desks to replay the domicile rules for clients. I think we could patent that, and we could all buy one.
Sal's example about Pennsylvania, just for fun. If you have a self-employed husband and wife who both earn enough or profit enough that you have a New York City UBT situation. They then go to escape to their summer house in Pennsylvania in one of the 400 plus municipalities, which has a local tax. You're going to end up paying New York State, New York City, UBT.
No, you will not pay UBT.
Well, you'll pay at least some, because you have a permanent place. You're going to file the return and pay some.
Yeah. But you'll allocate whatever you're paying Pennsylvania, you're not going to pay UBT. That's the one great thing is UBT does let you allocate based on where the work is done, not where the office is.
Understood. And then, of course, you're going to have Pennsylvania and the PA local tax as well. So it's going to be quite messy, and I think there's going to be lots of examination and lots of penalties for missed filings, especially the Pennsylvania local return.
I have to give a shout out to Marilyn Ratliff, who said California is also very aggressive. Yes, California is another state that is going to be very interesting to work with. California, the only thing with California, though, is that it's kind of hard to move out of California, that it's so big. Here in New York, I mean, we're just so compact and whatnot that, 30 minutes away, you're in Jersey, 30 minutes away, you're in Connecticut. With this. So yes, California is also an interesting state in a lot of ways.
And we've been talking about income taxes. Wait, I'm sorry, Shelley. We've been talking about income taxes, but this is also important for estate tax purposes. So if you're looking to change your domicile, let's say to Florida, you have to, so we were just in the middle of an audit where New York State came in and said somebody owes $250,000 for 2018, 2019. Actually, for 2018, we said, you know what? We're going to bring in 2019, but we want a global settlement and show that he changed his domicile before 2020. He was stuck in Florida. He got there in October. Normally you stay till May. He stayed till September. He's not giving up his place in New York, but it's clear that he's not really going to come back that often. Maybe to see some grandchildren. And so we wanted a change of domicile, and New York State was willing to give it. Usually they're not so willing to give it. So that's really a key planning point at this point. Usually you need a reason to change your domicile. You're retired, you got married, you got divorced, some other reason. And here COVID is a good reason why you've decided to leave New York.
Well, I mean,
Another interesting thing that our clients have to look at, because I had one client in here in my office the other day, within some of them are now smart enough to realize that Easy Pass is an easy thing for New York State to look at, right? And then I mentioned to him, and I said to him, I said, Tom, what about your cell phone? What do you do with your cell phone? And he looked at me and says, you mean they get my cell phone records? I'm like, absolutely. And that cell phone is with you, right? It's in your hip pocket. And that cell phone's in Queens. Meanwhile, you're saying you're in Pennsylvania. That's going to be an interesting thing. And, we have to look at our clients and just remind them of the things that New York State's going to look like. And Easy Pass is one, but they love that cell phone. And, and most of us, are glued to it. And, it follows us every second of every day and whatnot.
So New York State subpoenas that, but they do need authorization from, I think it's AT&T from the taxpayer in order to get it. And also, we always say it's not always so reliable, as you're saying. If you're driving from Connecticut to New York or New Jersey to New York, it might ping every 5 minutes, New Jersey, New York. And so it's not reliable because it's going off the strongest tower, not necessarily the closest tower.
Karen,
you need an app that has a GPS, like tax day, tax burden, or Mayo, or actually Google Maps keeps track. Again, it's based on GPS, and that's more reliable.
And Karen, you're an excellent attorney. You're correct. It's the nearest, but it's going to be a fight. And that was my point to the conversation, is that it's going to be a fight when they sit down and say, well, here's your pinging records, and you were in Queens for 4 hours. Now, you may be stuck in traffic. And again, we can argue all that. Yeah, I was stuck in traffic for 4 hours. But again, it's an interesting thing to look at, that, again, your cell phone may be a problem with all of that. So,
but there's something else to talk about right now, which is that we're talking about 2020, but we have an opportunity for 2021 with our clients, because they are out of the city now. And if they truly don't want to pay taxes and they don't want to abandon their domicile, then we need to educate them that they can't spend more than 30 days in the city in 2021. And if they do, then they can't turn around and say, but why aren't you making me a New York City non-resident? You can say, well, look, I told you in January, I told you in February, if this is what you want to do, this is the criteria, these are the rules. If you follow them, you could potentially save your New York City taxes.
So Shelley, tell everybody that exception. Not everybody knows about the 30-day exception. Why don't you tell everybody?
Right. So if you're a domiciliary of New York, which means you have a closer connection to New York through a series of factors, as long as you spend less than 30 days in the city, you're a statutory non-resident. And so you don't have to pay city taxes. And there is another exception that might be relevant, because a lot of people come from another country. They could work anywhere in the world. And they say, something with the pandemic, I'm going to go spend time with my family in Italy or in England or in Ireland. Well, there's the other rule for people who are working abroad, where if they stay out of the country for at least 450 out of 548 days, they are also a non-resident of New York. So it's possible that people who were here till March, who decamp to a foreign country, who do not come back, for a year and a half, because 548 days is effectively a year and a half, could potentially be New York non-residents, and we won't know that until 548 days have passed. So, you may have to determine it sort of what they're planning on doing, and if things change, you might have to go back and amend a return if they spend too many days in the city.
There's really a great opportunity for a lot of planning here. That's really the bottom line.
Right.
I do, we started off talking about the convenience rule, and then kind of went into all things residency, which is great, because that's, all of these issues are connected. But I do want to pull it back a little bit, specifically to the convenience rule, to just note a couple, two quick things. Shelley, you had mentioned that situation where you've got the, New Yorker who camps to Connecticut and is working for the New York employer. And in that situation, Connecticut, as you said, will give a credit for the tax paid to New York as earned income. But if you're a resident of two states, you get taxed twice on the unearned income. So we all get that. But what scares me even more than that is that situation isn't the worst possible case, right? The worst possible case is, let me give you an example. The exact same situation, except that let's substitute Colorado for Connecticut. I'm going out to the mountains. I've got a ski lodge there. I'm going to head out to Colorado. I'm going to ride out the pandemic there. But in doing so, I become a resident of Colorado rather than Connecticut. Here's why this gets worse. Colorado, unlike Connecticut, has a rule that says, well, wait a minute, Connecticut would give you a credit. What, are you kidding me? You're earning income here in Colorado and you're a resident. Why would I not tax that? So if you have a state that is unlike Connecticut that won't give that resident credit, suddenly you're double taxed not only on your investment income, which certainly is always maybe substantial for taxpayers, but this is a situation where you're double taxed on your earned income because of the difference in how those two states source that income. New York's going to apply convenience rule and say, even though you're earning it in Colorado, it's a New York employer, you owe us the tax. Colorado's going to say, you're living and working in Colorado. Why would we not tax that? And there you have double tax on all income.
Joe makes an excellent point. Excellent point. Thank you, Joe. Excellent.
Yeah, it's true. And it's scary because the other thing is, New York gives you a convenience of employer rule, and they say if you're working in New York beforehand, you're subject to New York tax. But it's, we don't know if other states bring it in. They say, well, New York is unconstitutional what New York's saying, and they're trying to take our tax revenue, like the Massachusetts and New Hampshire case. It could also be for that period of time they decide, it might not just be Colorado, it could be other states that say, this is not New York sourced income, this is our sourced income, and we are taxing it, just as you said. So it's going to be interesting how it plays out. And I know there was a proposed federal tax law, and I think at this point, the federal government should take up something, and there should be uniformity across. I know the whole states write things, and you can't control stuff, but how, as a mobile country, can we not have uniformity of the rules for states? I mean, I know we don't, but we should.
And again, Shelley, you know what? It'd be awesome if the federal government tried to do something along these lines. And again, with it, the world changed drastically in March of 2020. Okay, we were heading into this remote society. Now it got forced, right? It got forced onto us. And the various states are all juggling to try to figure out how they're going to balance their budget. And I think it's going to be balanced on the back of the average taxpayer who's not going to have the ability to hire a Joe or a Karen to fight their battles for them in every case. I think it's going to be just an ugly situation of out there. It's just a fact of life.
And it's going to get worse because it's not just the individual taxes and what we haven't touched on yet, and which affects even our small business clients who have employees, is where are your employees working? And do you have to in those states, and do you have to file entity returns in those states? Because
exactly,
you have employees working in those states. So it's a huge issue beyond individual taxes.
Shelley, you're exactly on point, because Connecticut can absolutely tell me that I have an employee in Connecticut because that's they're working from, right? And not only, and think of this, could we get in trouble because we didn't file as a foreign entity in that state?
Yes.
Could they end up coming to us and say, wait a minute, okay, Sal, you forgot to register as a foreign entity in Connecticut. I
was going to say qualification alone is an issue that generates a penalty. Forget about even getting to tax.
Yeah.
And payroll taxes and unemployment taxes, that we've been treating them as New York. New York says they're New York employees, but Connecticut, or Colorado says they're Colorado employees. You didn't register for employment tax. You didn't pay unemployment there. You didn't get workers' comp that covers people in that state.
And when a taxpayer gets bit, okay, we're talking to our practitioner friends out here. When a taxpayer gets bit like that, where are they going to turn for resolution? Where are they going to look for to pay it?
So the New York Law Journal in December, I think the last day of the year, had a big article about how the 2021 is going to be a big year for tax attorneys because of new laws under Biden and because of all these rules under the pandemic. So it'll be interesting. I mean, my phone has been ringing with these kinds of questions regularly.
I will say this, just going back to that point about federal intervention. I thought it was interesting. Prior to the pandemic, I would have said no chance in heck. There's been legislation kicking around for about a decade that's never gone anywhere. But I will say, with the Democrats preparing to use budget reconciliation, the Senate went through that vote-a-rama. They call it vote-a-rama. Yeah. Any senator can propose amendments. And what was interesting there is that Senator Coons from South Dakota, is it North Dakota or South Dakota?
Isn't Coons from Delaware?
Coons from Delaware, right?
Coons is Delaware.
I may be getting the name wrong then. It was either the senator from South Dakota, Republican from South Dakota, and the senator from Ohio, Sherrod Brown, basically came together to, advance an amendment that said, look, we're going to stop this convenience nonsense and we're going to say everything is status quo prior to the pandemic. So all these states that started effectively, applying a convenience rule, that's actually going to be the rule nationwide, where we don't change anything as a result of it. So businesses wouldn't have to change anything. It'll be interesting to see where that goes.
Thank you, Shelley. She just put in it. Senator Thune, Senator Thune, and Senator Sharon Brown. And it'd be awesome if that actually got off the ground and moved forward, Joe. Okay, yep. I wasn't aware of that, but it'd be awesome if that got off the ground and actually went somewhere and tried to help the average Joe, with it. It'd be awesome.
The other point I wanted to make, bringing it back to New York specifically now, is that, this convenience rule, it's not like unavoidable, right? I mean, there are planning opportunities here if you're a business to get around it. Now, some of them are more onerous than others, but there are 3 things you can do specifically to avoid the convenience rule. If you have an employee, working outside the state and the employee doesn't want to be subject to New York tax, the 3 things you can do is 1, telecommute 100% of the time, right? The convenience rule only applies for New York purposes if you spend some time during the tax year working in the state. So if you're 100% remote, it doesn't apply. Number 2, the business can obviously open an office in that state or in some other state and have you assigned to that out-of-state office, because the convenience rule for New York only applies if your primary or assigned work location is in New York. And then finally, the last thing, and the thing that is probably the one that is most popular, is creating a bona fide employer office in your home office. So in other words, basically making an employer location out of your home office. Now, there are issues that come up with each one of those things, and certain downsides to each one of them, but just be mindful of the fact, businesses out there, that there are planning opportunities to avoid New York's convenience rule.
Hey, Joe, can I play devil's advocate with you? Because you know that the answer to what our clients are going to say. How about independent contractor? Can't I just send them a 1099?
That's a tough situation because, look, New York, one of the other really, really aggressive programs that New York is going on is recharacterizing independent contractors as employees. And ultimately, it's a facts and circumstance test. They're going to talk about how much control and direction and oversight the business has over the person. And New York readily recharacterizes independent contractors as employees. And if that's the case, then you're in a whole world of soup from the labor and employment side of things.
But Joe, all my colleagues are doing this. That's what they're doing. Why can't I do it, Joe?
There are certain circumstances where I think you can do it, but you better be careful. You better do it right. I would refer you to 2 of my partners here who I think, that's all they do all the time, Pete Godfrey and Pete Godwin. It's a risk.
Thank you, Joe.
So with that worker who is always at home and doesn't have a dedicated home office established, but is 100% telecommuting, does that give you nexus in that state, or does it depend state by state?
So it depends state by state. There are some states, if this is just a pandemic issue, then there are some states that have specifically said that if you've got someone working remotely as a result of the pandemic, that's not going to create nexus. They're giving it a pass.
But that's not the 100% example that you gave, because that didn't happen in 2020. I'm saying typically if someone always works telecommutes from home, what would the situation be?
I don't think you have a reasonable argument if you have an employee performing services 100% of the time in a state. I'm not familiar with any state rule that would protect that business from establishing nexus in that state.
Right. And I have another interesting thought that I thought about before, which is the way New York presents their W-2. So let's say someone does get transferred to another office. There's companies that have New York and New Jersey offices. They live in New Jersey. They get transferred to the New Jersey office as of March, and they're no longer a New York employee. Well, when we get that W-2, because of New York's ridiculously stupid, convoluted W-2 rules, that W-2 is going to show that 100% of the income is New York income. even though we know 100%, like, we have clients who work on films. They might work 2 weeks in New York, but their W-2 has all of their wages for New York. So now we're going to have to make the determination for anyone who potentially may not have New York source income anymore. They've worked for the same employer, but their W-2 also is New York income. I mean, like, what has your experience been with New York State's reaction to that when you're making the allocation of what should be New York and what should be non-New York source income?
It creates a headache more than an ultimate liability, right? I mean, at the end of the day, it is what it is. And if the documentation doesn't accurately reflect what actually happened on the ground, it's those facts that carry the day. Now, having said that, I totally get what you're saying, because it creates a fight. It creates an unnecessary interaction with New York. It creates a fight that they're going to take the first position as the most aggressive position, saying it's all New York, and then it's suddenly, your burden to prove otherwise. So I get it. It's a problem. But ultimately, if the facts are what you say they are, you should be able to demonstrate that, no, under the law, only that certain small percent that you've kind of detailed is New York source.
Right. And the other thing is, like, has anyone lobbied New York to change this? Because it's just a ridiculous, like, we're constantly telling clients that they have to get us their pay stubs, because we have to see on the pay stubs, it shows us where the New York income really was, since the W-2 doesn't reflect that. And it's problematic.
I think we're going to be seeing a lot of New York State audits in this area, and not just for the allocation of income telecommuting rules. I think we're going to see a lot in the change of domicile and the statutory residency rules. I see that there are a lot of questions actually in the Q&A relating to change of domicile and what New York State looks at. They look at the 5 primary factors of where's your home, your business involvement, your items near and dear, your time, and that's not the 183-day rule, and family, usually where the minor children go to school. But obviously, if they're going to school remotely, that's an interesting issue to look at. And then, of course, they do look at the other factors. Most people think they look at the driver's license and the voter registration and those kinds of things, but that's really just secondary. It's not what they're the main focus of what they're looking at. And a day is anything. The second you're in New York State for a second, you're in here for a day.
So wait, Sal, before you start, so can we take this one step further? Because I think a very common thing we're seeing is the New York City resident who moves to their upstate house, their summer house, or they rent something outside of the city long term while continuing to own or rent in the city. So what does that do to domicile? Are they still New York City residents?
Right. So you're a New York City resident until you're not a New York City resident, and you have the burden by clear and convincing evidence to prove it. New York City has the same rules as New York State.
And I love the way Karen said that. Okay, you are a resident unless you can prove you're not. And how do you prove you're not? It's great, Karen, that you mentioned the fact that driver's license, voter's registration is now secondary. 30 years ago, that was the primary thing, right? That was the primary thing, and how the world has changed, right? Now everybody knows where you have to change your driver's license and your voter's registration. But I'll go back to that cell phone that says that you were in New York, 9 months out of the year, okay, with it and not. And again, the cell phone is the one thing that I love to hound on, because it's the one thing that even a good client of mine, I told you, Tom, that said, "Oh, don't worry about my Easy Pass. I'll stay in the lane and I'll pay it." Okay, with it. I was like, "Great, Tom. Was your cell phone with you?" And he looked at me. He's like, "You mean they can ask my cell phone?" So again, it's great that you mentioned that the driver's license and registration is very secondary. I'd almost say it's third on the list. They have better things to look at.
The way that I look at those 5 primary domicile factors, they're just levers, right? You have a case that you have to prove. You have to satisfy your burden. And there are 5 levers you can pull to help satisfy that burden, to prove your case. And you might say, okay, well, look, the time factor, well, that's great. That's awesome. As a result of the pandemic, I spent almost no time in New York City. Okay, that's excellent. That's one factor. That's one lever you pulled. But hang on. Did you try, you're talking about changing your domicile. Did you keep the New York City apartment? Well, okay, I'm not saying you have to get rid of the apartment to change your domicile, but that's one lever you chose not to pull. What about the kids? Did you keep the kids in New York City schools, or did you take them out and put them in schools somewhere else? If they're still in New York City schools, you're going to have a heck of a tough time proving you've changed your domicile. What about business? Is your business still located in the city, or did you do something did you open an office in Connecticut, or did you do something to change that? If it's still in the city, you didn't pull that lever. And so at the end of the day, you add up all these different, you look at the totality of the circumstances, see what levers you've pulled, how much weight you can kind of put on each of them to come to the determination. But if at the end of the day, all you have is, I wasn't in New York City during the pandemic. Oh, and by the way, once the pandemic leaves, I'm probably going back to New York City. There's just no way you're ever going to win that domicile fight.
So you call them levers. I call it a balancing scale. So for each factor, New York is comparing New York to where you're claiming your domicile is. So how much time are you spending in New York versus where else you claim? And pre-pandemic, perhaps you claim you live in Florida, but you like to cruise. So perhaps you would get on a boat and go away for a long period of time. And maybe you spent more time in New York than Florida because you're vacationing the other time. New York says, guess what? You were in New York more than where you're claiming is your domicile. So they look at each factor one by one. I was once on a panel with a number of estate planning attorneys from a number of different states. And the guy from Florida who worked for a very large law firm said, I tell everyone to change their license, change their driver's license, their voter registration, et cetera, actually vote there. And when we put change their will, we put their new address in the will. And I said, thank you so much, because every one of your clients is going to need me, because you're really not talking about the primary factors. And the audience loved it so much, and so did the ABA, that they asked us to write an article with all the different perspectives. And we ended up in the Journal of Multi-State Taxation talking about all the different states, because every state had a different rule and not everybody agrees. And so you really have to know New York specific if you're dealing with New York.
Right.
So let me throw something out about New York. We keep saying New York, New York, New York. So some of us have sat down with these 3-year full-length New York State or New York City residency audits, which are a bear. There's no way the state's going to be able to do that. Also, going back to the levers, right? Some of the levers there are the purchase of a property, but no New York return being filed. But what do you think they're going to do if New York has 100,000 returns they'd like to look at? Are they going to do letter examinations? Are they going to do, as they've done with IRC 183 issues, where they just eliminate it? Can we see them eliminating the resident credit, for example, or adjusting New York income to match federal AGI? What do you folks think is going to happen here, considering New York is also broke?
They have a very sophisticated computer system that does some kind of I'll call it auditing of every return. And they're looking for the deepest pockets and the ones where they're going to get the most money. And then they're going to be pretty aggressive. But I've also seen, that's usually a field audit, but I've also seen letters coming from desk audit, which I think is unusual. And Joe, you could probably speak to that. I know someone from your office was talking about that recently on another panel.
Yeah. So look, to your point, I just saw a meme that made me chuckle this morning. It was a picture of Governor Cuomo, and the caption of it was, Florida Real Estate Agent of the Year, because everybody's getting the heck out of New York and moving. But look, are they going to go after all these people, and can they? That's the question. Number one, I right now, unless they ramp up audit, auditors, or switch to doing more desk audit, I just don't think they have the capacity. So they've got to change capacity. I think the number one thing they're going to do is desk audit, because that's already there. They can start sifting through what are kind of the lucrative, the ones that might have an issue, just with a simple questionnaire, send back, give me your response on these 5 factors, start it off at desk audit and then refer it. But what we've been seeing with desk audit in particular is if you have for example, a real estate transaction or a large capital transaction, you sell equity in a business or something like that, those are the things that we're seeing initially kicking off the desk audit examinations, at least right now. I think that changes. I think that in the future, you start seeing desk audit used more in the traditional, just, the change in pattern, where you go from filing a resident return to filing nothing or filing a non-resident return. Suddenly, boom, desk audit takes the first pass at a good chunk of those.
But I agree with Joe. I think that's exactly what's going to happen here. Okay, with it, we've seen that. We had a client who moved out to California, sold the property here with it, and again, New York State is trying to insist that they're a resident of New York State on it. So I agree with Joe that they're going to be looking for the deeper pockets. But where I disagree is I think they're also going to be going after and I'm not going to say necessarily the average Joe, but I also think they're going to be looking at this from the standpoint of that some of these people are just not going to have the ability to fight it. That, you know, with it, that, you know, I just saw Norman made the comment that sometimes the cure, it costs more than the tax, okay, with it. And regrettably, I do think that New York State looks at things like that and say, okay, well, great, you want to take it all the way to the tribunal? Great, hire Joe, hire Karen, give them $20,000, or you can pay us $4,000, okay, with it. And I'm sorry to say that but I just see that as a fact that it's going to happen.
I mean, what I was going to say is an answer to what you said, John, about how they're going to deal with it. Think of what happens when we don't file an IT 360.1 for a client who was a New York City resident 1 year, and they moved December 31st, and they really don't need one for the next year. But if you don't file one, what's New York State going to do? They're going to send you a bill charging you city tax. So I believe the clients who paid city tax last year, who don't file an IT 360.1, who do not pay city tax this year, will be getting a desk audit letter automatically assessing the city tax.
No, I agree with Shelley, no doubt.
I don't think they'll get the desk audit. I think they'll just make a New York City return and send an adjustment.
Yeah.
And the thing they've done with the 183 letters, they don't tell you this. You have appeal rights, or you can change it. They just present it as the return is wrong. Here's the bill.
Yeah.
Yep.
Yeah.
And I agree. I think that we're going to be seeing a lot of those, and I think the answer to that, Shelley, is that you have to file the 360.1.
Yeah.
Okay, with it, and with it. If you don't dot that I, the not crossing the T is going to get back to bite us. So we're going to be
we have a similar issue with, forgive me, younger folks who rely on technology and don't double check things, don't look at their W-2. So they have a whole year of New York City withholding that's wrong, right? So we file the return with no, as Shelley would say, with no 360, no New York City on it, looking to get the withholding. Typically they do what? They tell you the return is wrong and add New York City tax onto it. So some of these problems are self-created, but
I think me and Shelley are going to be busy this year, and not so much Joe and Karen are going to be the self preparers, right? Okay, with it, those people who get those letters and whatnot. I think, you know, the non-attorneys in this panel, we're going to be very, very busy fixing other people's mistakes, because here again, like my son, right? If it's not on the phone, they don't need it, right? And it's going to be a lot of people that are being self-prepared that I think are going to be an interesting year. And it won't be this year, right? It'll be 18 months from now when all those letters start to pop in, that we're going to be very, very busy with these people.
And it's a good client source, because when you fix a problem for a client after they've screwed up doing it themselves, you often have a loyal client for life, because they realize that maybe they're not as capable as they thought they were of handling their taxes. So it might be a marketing point, like in a year or so, you start marketing in your local area saying, you know, problems with residency, you know, I'm an expert, I can fix it. And, you know, maybe you'll get yourself some good clients.
And the good thing about this is that they know, every one of them know at least 10 other people that are in the same boat. So I agree. It's going to be a busy representation cycle coming up.
So exactly to that point, we get calls regularly from people who thought that they had a representative that knew the rules, and realized after they got a bill from New York State that their representative really didn't know the rules, and perhaps at that point already gave too much documentation. We represented a guy who in year 1 bought a place in Florida, in year 2 sold a business in New York State for millions and millions of dollars, and the representative gave copies of anything and everything, including the 3-year consulting agreement that goes on after he claims he moved. And New York State sent him a bill for millions of dollars. And then he came to us, and we were able to save him a little bit of money. But not everybody knows all the rules. They think they do, but they don't.
Absolutely. So I want to steer this just a little bit, keeping in mind that a large number of the folks that are on here are practitioners, right? We're slugging it out doing returns. Maybe we're not doing rep and planning as much as we should. So can I throw out to the panel a couple of the common things we're seeing and just get your feedback based on what we know today? What do you guys think?
Sure.
No, everyone's like, what's he going to ask? So,
Please.
A New Jersey resident is sent home by their New York City employer to work. what if they no longer have a seat at the office? The office is closed. So we know that's a New York job and they're supposed to pay New York non-resident tax, whether they're working or not, whether they're working from home or not. But what if two situations? First, what if the employer has closed that office completely? And in a second situation, what if they are at 25 or 50% capacity because it's a non-essential business and they're following the governor's executive orders? Any thoughts?
The second one is easy. Oh, go ahead, Joe.
It's a great question. Look, as you're going through these, I'm reminded of New York case law, right, where New York has already construed the convenience rule. And there are two cases where an employee's office job was discontinued. They took away the office from these employees. One was called Matter of Unterweiser, and the other was called Matter of Dervers. These are New York State Division of Tax Appeals cases. And the problem with this is that one came to one conclusion, said the convenience rule applies. The other came to the exact opposite conclusion and said it doesn't apply. So it's difficult to understand the convenience rule and how it's going to play out in normal circumstances. And now on top of that, we're going to throw on, New York has clearly said in that New Jersey situation, New York's taken the position that you've got to pay New York tax. The frequently asked questions that New York published did not make any exclusions, any exemptions for, essential workers or stay-at-home orders or emergency declarations, nothing. It was silent on all that. So New York's going to take the position it's taxed to New York. Now, is that reasonable? Do you have a legal argument to contest that? Yeah, I think you do. Like the one taxpayer who won when the desk job was eliminated, you've got an argument for saying, you've got to be kidding me that this is of convenience that I'm working at home. It's not convenience, it's necessity. I can't work anywhere else. And I think there's going to be a lot of cases coming out of this pushing back on New York's somewhat blanket starting point of the convenience rule applies.
Like Sal said, it's going to be very expensive to litigate it. And the common Joe is not going to know what to do. And as I said, we had Joe Carzo on a panel, and he very clearly said, the FAQs speak for themselves. Nothing has changed. You owe tax in New York. There's no question. And if he's head of audit, that's the position audit's going to take.
Let me ask you this just to follow up for both of the attorneys or for anybody. So let's assume that I think that, my employer didn't have a seat for me, therefore it shouldn't be subject to New York tax. Should I file the return on time, removing the number of days, right, and just pay what I think I should be paying, right, using that day count formula on that's the schedule? Or should I file the return, pay the tax correctly, or at least according to New York's FAQ, which is it's all taxable, and then amend the return? So I filed and I paid the tax. I'm not going to be subject to a penalty. Do I amend and see what happens? What's a better course of action for practitioners if they have a large number of clients with this position?
Good question.
I can tell you from my perspective, not never, but I very rarely counsel a client to pay the tax. If you're going to take the position one way or the other that you're going to fight, so you're going to file the amended return and bring on the fight, the difference is the penalties and interest that can accrue. I think in this particular situation that you have a strong, penalties. In order to get penalties abated, you've got to have reasonable cause, right? As that's defined in the New York regulations. I think that under these circumstances, you're going to get reasonable cause. I think you'll find reasonable cause, given that you're dealing with a pandemic, to get rid of the penalties. Then I think that, what about the interest? The interest still accrues. That's true. But when you are fighting a fight with New York, and New York has the money, you lose a lot of leverage in the negotiation, or if you don't want to take this all the way to trial, most of these cases get settled at some point, whether it's at BCMS, the mediation, or with the attorney for the state at Division of Tax Appeals if you're going to protest the assessment, or the refund denial, whichever way you go. So look, if you're going to have a fight, from my perspective, I might be a little overly aggressive. I'm kind of a pugnacious lawyer, but if you're going to have that fight, it's better for you to have the money than the state, because you have more leverage in the ultimate negotiation. I think those taxpayers end up doing better. That's my guess.
I'm also going to agree with Joe, John, and as a non-attorney, I think that you take the position on the return that you think is correct. I don't like the amended return and then explaining that, well, I did it that way, but then I rethought it, and I think this way is better because I got a refund out of it. So honestly, John, it's the same thing I do on the federal, which I know we're talking about New York State right now. I take the position often. I'd rather fight the battle up front than file it and then file an amended return and fight the battle afterwards. That's usually the position I take. If I feel I am more right than wrong, that's the way I tend to prepare returns, and that's the way I go into my representation cases.
And I want to jump in and talk about the penalties, because we also had R.G. O'Leary on a panel recently, and she's the Deputy Commissioner of Civil Enforcement and Collections. And she specifically said that with respect to not necessarily these penalties, but with respect to other penalties in the sales tax realm, the realities of life, she said, I've instructed the staff to be generous in reading the definition of reasonable cause because of the pandemic and the realities. So she realizes what's going on. And she even said, with respect to unemployment, all these people are getting unemployment. She said, most people are not withholding. And she realizes that next year, all these people are going to be surprised when they owe tax, and that she's going to be dealing with a lot of people who can't pay their tax. So it's going to be an interesting few years, I have to say that.
And then there's another issue with I mentioned New York reporting all of the income on the W-2. That's possibly an opportunity, because if we go talk to our clients when we're doing the tax returns and they say, no, my employer reassigned me to my New Jersey office, but your W-2 says New York, and you say, well, it doesn't appear that way. There's nothing allocated to New Jersey. Potentially they could get the W-2s amended because the New York reporting wouldn't have changed anyway. They would have put 100% of the wages on there. So maybe that's how you end up in the past. You get the employer to correct things.
Yeah.
Okay, so we talked about New Jersey, and we talked about the client who moves, the New Jersey worker, New York non-resident. We talked about that, and we talked a little bit about the New York resident who hides upstate and the UBT, and as Karen said, the New York City residency issues, whether you've shown that you broke residency or not. What about the New York resident who goes to Connecticut to their summer house and they trigger statutory residency? So can someone explain statutory residency to us first? And then let's talk about who has the first right to tax, or we kind of covered this, but let's go through that example. So what's statutory residency?
Sure.
Yeah, I think Shelley said it best earlier. Shelley very clearly said that you're going to be taxed as a domiciliary in New York, a statutory resident in Connecticut, and the only credit you're going to get is for earned income and not on the intangibles, interest, dividends, capital.
What's a statutory resident, though, for people that are unfamiliar?
So you have a permanent place of abode in New York, and you spend more than 183 days here. Permanent place of abode that's maintained for more than approximately 11 months, substantially all of the year. And that means you have unfettered use and access. You have your clothes hanging there, your toothbrush. You're able to come and go as you please. Doesn't matter if it's in a trust, the lease is in someone else's name. You have access to this place, and that's a permanent place of abode. And you're here more than 183 days. And any second in New York is considered a day in New York. So if you live in Connecticut and you pick up the babysitter in New York, or you go food shopping in New York, that's a day in New York. There are a few exceptions if you're just traveling through to get to the airport. But if you stop and have lunch with your daughter in New York City, that's a day. And there are medical exceptions if you're an inpatient in a hospital. So the person who's the inpatient in the hospital, that day is not counted, but the spouse who's visiting, that day is counted. And so you can have a moneyed spouse and a non-moneyed spouse. Again, those are the issues.
Karen, thank you for bringing that up. There actually is a case. Was it last year? You guys would know better than me. Was it 20 or 19 of a spouse that spent too many days on the bedside of his sick wife, and he got taxed as a New York resident with it and whatnot, and it kind of shocked people when it happened. Okay, with it. But thank you for bringing that up, because I was going to bring that up. Let's not forget that sometimes the husband and wife are not the same, right? There are facts and circumstances in which they are different, and the spouse being sick and the other spouse staying there and doing the right thing ended up being taxed by New York State. Isn't that just a crazy outcome? Who would have thought?
And they could also file separate returns if they have separate domiciles. So New York allows for, different lifestyles. So someone could live here and someone else could live there. And, often we see the moneyed spouse says they live in Florida.
Yeah, New York actually allows an exception, right? If I file jointly on the federal, but I live in separate states, you're allowed to file the state, the New York return MFS, and the non-resident taxpayer doesn't file. So that's an interesting.
Yes, and these days we're doing more and more of those. But the sick spouse was one of those cases that, again, just hit everybody from the outside. Who would have thought that just because I was being a good husband, suddenly I'm taxed to the state of New York, right? Who would have ever thought of that? Who would have ever thought that that New York State would do that? But I'm slightly off the key. Thank you for bringing it up.
The real problem is the insurance rules. So pre-COVID, if you were in a hospital for a procedure, now they throw you out in a day or two where maybe they would have normally kept you for a week. Now you're laying on your couch in your apartment in New York City. That's not an exception to the day count, but you really can't move anywhere.
But in John's question, the fact pattern, the statutory residency wasn't New York. The statutory residency was was Connecticut, but they were domiciled in New York. So the New York issue was that they were domiciled in New York and had more than 30 days in New York, so they had to pay New York taxes. And Connecticut, because they spent more than 182 days there, they were a statutory resident of Connecticut, right, John?
Yes, ma'am.
Yes.
And by the way, I do just want to mention about that 30-day rule. Just 'cause I don't think we've mentioned it yet. The 30-day rule is very useful for planning if you don't spend more than 30 days. But keep in mind that there are other kind of onerous elements to that rule, that exception, meaning that you have to maintain a permanent place of abode outside of the state for the entire tax year, and you can't maintain a permanent place of abode in New York for any portion of the tax year. Those are the two provisions that kind of make the 30-day rule very difficult to comply with. You've got to get it.
I thought the whole point of the 30-day rule is you do have a permanent place of abode in New York.
No, you have to get rid of your permanent place of abode in New York for the entire tax year. You have to have a permanent place of abode outside New York for the entire tax year and spend no more than 30 days inside New York during that tax year. For the 548-day rule, you're allowed to keep a place in New York. That's the foreign exception, the 450 days. But for the 30-day rule, you've got to get rid of the New York place. And by the way, we've had clients who have done that. I mean, we've had clients who are on the verge of a massive, equity. They're selling their business, hundreds of millions of dollars at stake, and they come and they say, Joe, I don't want to risk this domicile fight, this facts and circumstance. I don't want to worry about pulling levers. I want a surefire thing. And they're willing to sell their place. I say, okay, look, if you want an absolute bulletproof thing, then sell the place in New York, before the year starts where the equity transaction happens, get a place somewhere else in the year before the equity transaction happens, and spend no more than 30 days in New York during that year. You're bulletproof.
Right, just come in and pick up your check when the closing happens, I guess.
Right, and not pay that New York tax on it.
Or wire the check to me. So
wire the check. There you go.
Let's move a little bit. So who's Chris Sununu?
It's the governor of New Hampshire, and he's very angry.
Wasn't he Secretary of State under Clinton or something? No, that was the other Sununu, Air Sununu, right? All right. So anyway, no, Chris was not. So Governor Sununu got mad. Now, New Hampshire is one of the unique states in our country because it has no what?
Income tax.
It doesn't have a tax. How they run the place? They have no income tax, and I think no sales tax. It's magic.
Well, they do have They do have some taxes up there.
Oh, okay.
They're definitely limited, and earned income, I totally agree, is not taxed. But there are certain elements of income that will be taxed there. They call it
Texas has no income tax. Florida has no income tax.
Amazing.
There's a whole bunch of states.
So we have a problem with Massachusetts.
Yes, we do. We're in New York. That's the problem, John.
The Massachusetts source income of non-residents telecommuting due to the COVID-19 pandemic. So Massachusetts said that what? If you're stuck in Massachusetts, you're going to pay us?
No. Massachusetts said if you are employed by an employer in Massachusetts, but because of the pandemic, you are working from home in New Hampshire.
Yes.
Massachusetts says we're instituting a convenience rule. You, despite the fact that you're working in New Hampshire, still have to pay tax to Massachusetts. And they ran out all these statistics, like 83,000 people per day cross New Hampshire's southern border to go work in Massachusetts. And those people are all going to continue to pay Massachusetts tax under this temporary convenience rule, despite the fact that they're working from home in New Hampshire.
Are you sure? I didn't know there were 83,000 people in the whole state. Anyway, but so seriously, so Governor, to his credit, Governor Sununu did what?
He sued Massachusetts.
And it's before the Supreme Court right now. It's before SCOTUS. There's an interesting thing here. New Jersey, Connecticut, Hawaii, and Iowa all filed briefs in support of that it's still they said that there was aggressive, that it was draining their revenue. Aggressive states like New York, Arkansas, Delaware, Nebraska, Pennsylvania, Massachusetts were siphoning off revenues due to the resident state credit. I thought that was interesting as well.
Yep, that's why I think that previously the Supreme Court had passed on opining on this issue when it was primarily a more localized issue, but now you got states suing one another. It's really aggressive. If you look at the language that Governor Sununu used, he's talking about having Massachusetts balance its books on the backs of New Hampshire residents. It's aggressive. So I think that the Supreme Court will take it up. Some people disagree with that. Some people think they're going to still leave it to the states, but we'll see.
Let's hope. You know what, Joe? Let's hope not. Let's hope that they pick it up and go forth with it, not punt yet again. With it, the Supreme Court doesn't like tax cases, and usually I agree with that. But in this particular case, let's hope that they don't punt on it and go forth with it. So,
yep.
So what does this look like, though? So let's assume that the Supreme Court comes eventually in favor of New Hampshire and overturns some of these state rules. This will be back to what date? The date of the lawsuit? Forever? How will they fund it? Will it be funded with credits? Will the states be issuing refunds? What happens here? If you had to guess.
There's a few different ways I think they could go. I mean, it's kind of like looking into the crystal ball right now, but as to whether or not it's retroactive or not, if it's based on a due process, a constitutional argument, well, your constitutional rights don't necessarily just start with the pronouncement unless they're overturning something. So there is the possibility for it being retroactive. But I think that the most likely scenarios are something like this. They're going to say, forget it. Physical presence rules, which is contrary to what they just ruled in Wayfair for sales tax nexus. But they're going to say, for income tax nexus, the state where you physically earned it is the state that gets to tax it, right? So that way you just got to track physical presence, and that's where you get to earn it. The fly in the ointment to that approach is, and most states don't like this, especially New York, Connecticut, Pennsylvania, the states that have passed the convenience rule, is that it puts residents of the state at a disadvantage as compared to non-residents, right? So if I'm a New York resident and I work from home, I still pay New York tax. If I'm a Connecticut resident working for a New York employer and I work from home, well, then I don't pay New York tax. I pay my lower tax rate in Connecticut, right? So it prizes, it benefits, it incentivizes non-residents, and states don't like doing that. So that's the drawback to the physical presence rule. The other option that they could go with is they could follow the legislation that's been kicking around Congress and impose kind of a national standard where you've got, it's like a 30-day, requirement where if you're working in a state, less than 30 days, you don't have to worry about anything. Everything just reverts back to what your normal work pattern is. If you're in over 30, then you do have to start worrying about, withholding and all that other stuff.
So let me help Joe with this because he talked about a crystal ball. So this is where I get my answers from. Okay, with it. So let me go ahead and see what the Magic 8 Ball says. And the Magic 8 Ball says, ask me again later.
That's the exact right answer, because then we'll know what the Supreme Court does.
And I want you to know that I had to shake
for all the practitioners. That's all I can say.
So just that you know, I had to shake the 8 ball to get the right answer. The first one was different, okay, with it, but I wanted to make sure I got the right answer out of it. But thank you.
Al, I just said it's going to be a very complicated year for all the practitioners. I could only see that.
So
gonna be an interesting-
poor Shelley sent me a text the other night. You know, she shouldn't be up at night thinking about me, but she was.
Always. The ex-Shelley, the soon-to-be future ex-Shelley Shealy, is that
Shelley
what?
Shealy. I always thought that would be a great name. Tell us about you were discussing the pass-through entity,
Right.
right? So why don't you lay that out, and then let's have the panel talk about it.
So basically, a case, and I'm not a case head, I don't know case numbers, but the case just came down where the federal government has seemed to okay a pass-through entity tax for corporations to pay the tax when the state will then give the person who pays the tax through the pass-through entity credit on their personal tax return as a workaround for the limitation of SALT deduction. So New Jersey just passed an elective law where you can choose to pay New Jersey corporate entity tax when you file, and the states are smart. They're not giving you a full credit for what they're charging you in tax, but they're giving you enough of a credit where they get to get extra money and you get to save money because you're effectively deducting the tax paid at the entity level, reducing the tax paid at the personal level. And Connecticut has one already. And the Connecticut one, what happens is you pay, is it 7% or 6.7%?
Yep.
Around 7%, Connecticut will charge you on your entity return. And when you do your Connecticut tax return, your credit equals about 6%. So Connecticut's getting to keep an extra 1% in all the money you make. You're not paying double tax because on your personal return, you're getting a credit for anything the 6% tax that the entity is paid to Connecticut. You're paying 1% more, but the fact that 7% becomes deductible, if you're in the 37% bracket, it's only costing you, I need a calculator for this. So it's costing you 4.41%. Even when you add the 1% that the corporation pays, it also saves you 30%, so 0.63%. Your net after-tax cost of tax in Connecticut is only 5% instead of 6%. So there are going to be states where you have to make the election like New Jersey, and I truly believe if you don't make the election for your clients to do that, it's going to be malpractice because you're not saving them the tax that you could potentially be saving. But I did do a little bit of analysis to see, let's say you're living in New Jersey, and you're working in New Jersey and you're living in New York. What's going to happen for the credit for taxes paid to other jurisdictions? But they seem to have figured it out because they don't show it as a credit reducing your tax. They show it as a withholding credit. So when you look to the line that we typically get our credit from for taxes paid to other jurisdictions, it's a tax calculation. So the tax is still showing on the Connecticut return of 6%, on the New Jersey return, the graduated rates between 2 and whatever, 11 or 12% now. And it looks to me like you will get the credits between states because it's not reducing your tax, it's reducing what you owe by being treated as a withholding credit. Did that seem clear or convoluted? I'm not sure.
I'm sorry, Shirley. Can you start that over again?
Watch the video replay later, Sal.
So it's an interesting, it's a workaround to the limitation on SALT deductions, and it seems to be a workaround that's worked. And New York is introducing it, and now that they sort of know that the states, that it seems to be sanctioned by the federal government, I think we're going to see it on a lot more states. Now the question is going to be whether the Biden-Harris administration brings back the SALT deduction and whether we even need to do this. But while it does exist, some states it's mandatory, Connecticut it's mandatory, New Jersey it's optional. I don't know all the state rules, but you need to make sure that if you're doing an entity return in a state, you see if this exists, if it's an election, if it's mandatory, and you make the right decision for your client.
I think you're going to see the SALT tax go away because the GOP offered it in Congress with it, and the Democrats didn't pick up on it. So let's hope that again, sometime this year, that they pick up on it and go and run with it. It was offered, and there was no reason for them not to pick up on it. Now that the election's over, let's hope that they go ahead and do that. Maybe part of a bigger package with it, Shelley. But I think that's what's going to happen. I think this SALT thing. I think that this, in particular, this workaround that they've now signed off on, I think that's going to force them to just get rid of the SALT deduction all the way around and fix it. Let's keep our fingers crossed on that and go from there.
This might not, but it still might make sense to do this even if the SALT goes away because the AMT in the high income tax states. So even if SALT comes back as a deduction, this will still benefit people who would have had the SALT tax benefit reduced or eliminated by the alternative minimum tax, because they didn't take away the AMT. So once you get higher state taxes again, you're going to have the same AMT issue you had for the high tax states before, where you don't.
You are correct. If there's an AMT issue, it would be better for the people who don't have AMT. It just may just go away, and I'm hoping that again, the SALT deduction was one of those stupid ideas that they came up with. Let's hope that stupid can be fixed.
Right.
So here are my thoughts on the credit questions that you were asking, Shelley. First, I agree that because the IRS blessed this structure, states are going to be turning to it as an option. New York, as part of the governor's budget, has now proposed, has legislation out there that if it goes through the budget process, we might have this tax before too long. But I caution people out there because in our informal conversation, the question is, in your example, does a New York resident who's working in New Jersey and voluntarily pays this New Jersey tax, do they get a credit in New York for that tax paid to New Jersey? And, there may be a workaround. I agree. The problem is that if you look at the instructions to the resident credit form, as well as our informal conversations with the tax department, it's the tax department's position right now that credit isn't allowed. Now, I'm not saying don't take it. I'm just saying that, if you take it, you may have a fight on your hands, one. And the other thing that we're now seeing is that as a result of this legislation that was just, put out a few weeks ago as part of the governor's budget, New York has this credit, but it doesn't become effective until 2022. Part of the legislation includes an amendment to the resident credit that would say, yes, we will allow the credit, but that doesn't become effective until 2022, which begs the question, if New York does allow the credit, why does it need to authorize it as of 2022? So, look, I'm not saying don't take the credit. I'm just saying do it with eyes wide open.
Right.
And full disclosure to your clients.
Absolutely.
Right. Absolutely.
But if you live in the state where your entity is, it's a no-brainer.
No-brainer.
Right. If you don't know what's going to be, then you have to have a discussion and see if your client's willing to take the risk. That's a good point. Thank you.
Wow. So I want to talk. I'm going to throw a couple of things out and just see what your feelings are. These aren't directly related to state tax issues, but they are pandemic related. So we're seeing people are moving. I'm an employee in California, in San Jose. They told me to work remotely. Well, I guess that they're never going to ask me to come back to work ever again. So I moved to Texas, where I may or may not have told my employer. The employers are catching on to this now, and they're saying, gee, you make 20%. Our people in Austin make 20% less than the people in San Jose, primarily driven by the changes in the cost of living. So we need to right-size your pay. Where does this take us, folks? Any comments or no? It's not really tax related.
It's in Texas. I like the rhyme there, so I had to say it.
So my daughter has an interesting situation. She was working in New York, living in New York for a New York company, and she moved temporarily not temporarily, she moved to Texas. And they didn't change her pay at all. And she's living in a lovely place, 3 times bigger than anything she would have had in New York for a cheaper amount of money, less money and enough money to get 2 cars and live an amazing lifestyle.
And so, Karen, the question is she asked you, Mom, why are you still in New York and why aren't you here? Correct?
There you go. Go come visit the grandchildren. Exactly.
I will say though that, that concern is very real, because I can't tell you how many large companies that we counsel that have that exact situation where, and it's very common to make cost of living adjustments both up and down, depending on where people are coming and going from. So it's not uncommon. It's a conversation that happens all the time. And from my perspective, it gets very messy when you're talking to an employee saying, okay, well, yes, you can go live in that state, but understand that employees in that state are on a different pay scale than employees over here where it's much more expensive to live. So, it's a conversation being had.
I come from the airline industry in which, people in higher cost states get cost of living increases, but it's really not a lot of money, believe it or not. So if you take the people in New York, and I have a good friend of mine in his conversations 30 years ago who moved from New York and moved to Texas with it. Trust me that he lived a much greater lifestyle even without the cost of living increase because, again, it's a union, it was a contract and you're still making, $45 an hour. So yes, you're losing a $2 an hour or $3 an hour, but it goes a lot further in certain states than it does here. So it's a valid point. And I think that the exodus, as much as I heard recently that there is not an exodus in New York, that it's all wrong and it's all nothing but fake news. But I think that from what I can tell from my clients that have exited, unless they're exiting me and I don't know any better, but they're leaving. It's just a fact of life that the one thing that COVID-19 did do was clearly show us that we can work remotely. We don't have to be here. And it's a new world out there. And I think that that's going to go from there.
So the guy who started the pods that you could store things on in your driveway just started something called Red Rooster, and he's claiming that thousands of people are leaving New York every single day and that they need to be able to take those pods and put them on the equivalent of like a U-Haul and be able to drive somewhere else. So he just started a brand new business because everyone is leaving.
But by the way, I did see some questions come in asking about, we talked about statutory residency, but what are the rules in the various states? And two things about that. First, just about all the states in the Northeast have the exact same rules. In other words, they have a domicile and a statutory residency test, and all those statutory residency tests are based on a permanent place of abode in 183 days. Those states got together and formed this group called NISTOA, the Northeast State Tax Officials Administration or Association, and they all said, "Look, we want to avoid double taxes, so we don't want different rules in place." So if you're talking about Connecticut, New Jersey, Pennsylvania, Maryland, Maine, New Hampshire, they all have the same statutory residency test, and they get applied a little differently in practicality and in audit, but the rule and the law are all the same.
So there are a lot of questions. Should we be answering or going to look at them?
I wanted to make sure we hit all the material, and now we have. So sure, we can ask, we can do some questions. So going to the top, which are both a combination of older and higher voted. Someone said to you, this is great, will a recording be made available so we can review it again? So we won't give you the recording, but the recording will be available on demand. You'll get an email in 2 to 3 days when it's been posted. There'll be a little bit of editing and you'll be able to go and review it then. Okay, so good afternoon to all. Do you see New York applying their convenience test to employees who are New York residents claiming home office expenses as part of an IT 201 itemized deduction? So no non-resident issue involved. Reading between the lines in their instructions, it seems they want it to apply. I don't know. I don't think anyone's going to get audited necessarily over home office deduction, I guess, unless it's rather large.
But the home office deduction question during the pandemic is interesting because normally if you have another office available, you can't take a home office, right? Mm-hmm. But if you don't have another office available, and I think this applies not just to employees, but to self-employed people. I have many clients that couldn't go into their offices when they were closed down and they had to set up a home office. So technically they don't have another office available for the duration of the pandemic, or they're told that it's better for them to stay home when there's a limitation to how many employees there can be. I mean, I think we are going to see people taking home offices that normally wouldn't because of that rule. I mean, it's not a state issue necessarily, but it is an exception to a typical rule.
Correct. And I think that, again, it's important about the home office that it's not just it's for the self-employed people, not the employees, but for the self-employed people. It's someplace where you have to do administrative work. So even if you have a regular office that you go to, if you're doing administrative work in your home office, it's still a qualified home office. The question is it a exclusively used for the business, and you didn't sit there and watch Netflix while you were bored and whatnot and things of that nature. But I do think it's gonna go higher. Now the employee is an interesting issue. If the office was closed and you couldn't go there, great. But what happened a few months ago when offices started to open and the employer gave you the option? You can come in if you want to, but you don't have to if you don't want to. If you want to stay home, you can work from home. Now what?
That's not the exclusive employer, so in my mind, that's not deductible.
And I would agree with you. Regrettably, I think our clients are not going to like that answer, and they'll go to TurboTax and TurboTax tax. And of course, I can deduct it. Why not? With it. So I think it's going to be again one of those issues that come up when the clients don't get the answer that they're expecting to get, and we're going to have to deal with it.
And then the home office of self-employed people brings back to the New York City UBT issue,
right,
which is that if you're working out of your home office, which is out of New York, and this location of the work being done is outside of New York City, you'll be able to allocate that income out of UBT, since UBT has a different set of rules from New York City. I'm finding like we have a few law firms as clients where most of the partners decamped. Like you're in Buffalo, right? You're normally in New York, but the allocation is going to be very different. So I don't know about your clients, but a lot of my clients didn't know fourth quarter UBT tax, because once we started doing the analysis of what was earned inside and outside of the city, we realized that there was much less UBT source income. The other thing is going to be interesting, because it's like, how is New York going to require them? They're eyeballing their invoices. They're like, well, I know that, this partner was out of the city for 80% of the year. This revenue, 80% from this partner's revenue, we're just going to say 80% of it is non-New York source income, because they didn't track it all throughout the year necessarily, because they didn't even realize till the conversation in November that they even had to. So that's
I think we're going to start seeing, you're exactly right, Shelley, a lot of audits of that for UBT purposes, and you're going to have to do like a traditional workday allocation. Now, for people like us who bill by the hour, I've got a running tally of exactly what I did on each specific day on the bills that go out, right? And so then it's just a matter of matching up that day's bills versus, where I was on that specific day. But a lot of people aren't used to doing that kind of workday allocation work, and to the extent that they don't have they handle their burden of proof, to the extent they don't have evidence demonstrating the allocation that they've used, they're going to be in some trouble.
So Joe, there's a question about the Phillips case you mentioned at the beginning. Was that a DTA case? And do you know the first name of the person, or?
I don't think that was me. I don't think
that was me. It's I only know it as the Phillips case. With it, there's actually two cases that I like to look at. They're Phillips and Friedman are the two cases that I like to go back and look at as memory.
Say that again? Phillips and what?
The other one is Phillips and Friedman, Friedman. Friedman is the other case I like to look at. Those are the two cases that home in for me with it. So, and I think it's a 1999 decision. It's not a new one. I'm talking about the Phillips case. It's a 1999. So the answer is I don't know it off the top of my head. I know the case, but it's one of the ones that I like to look at when I go back to take these cases on.
Is that a DTA case? That's a DTA case or what?
State Appellate Division is where it went.
So that should be auditable. Okay. Googleable. Sorry.
With it, I can actually look it up and get it to you.
Okay.
With it, if not right now, at the end of this, I can send it to you and you can add it to the end of this, I assume.
Sure, we can do that.
Okay. Well, I'll get you the exact site for it.
Okay.
And I think Shelby's going to beat me to it. Look at it. She's already working on
it. There's a question. What does New York want to see for a change in domicile? I think we covered that. The 5 levers, the five things. If Kate, if
they basically want to see they want documentation for each of those things. Again,
right,
the burden by clear
word for it, right?
A moving truck receipt helps. You know what I mean? Like things like that. During the pandemic, there were times you couldn't move. Like I would say, if someone said, well, I left in March, I planned to leave, but I couldn't even get somebody to come move my stuff out until May, I would still take them out in March, even if the moving truck came in May, because that was when they were first allowed to do come in and out of the building because of specific rules, but that's a good thing. The change of school thing, I meant to comment when you were talking about that. This year's going to be interesting because most schools went remote. And as a parent, are you going to change your kid's school in the middle of the year if they can do it from wherever they are? So I'm interested in when you guys start representing people, a year and a half, 2 years, 3 years from now in tribunals, if the New York City school thing is going to be as big an issue. You have an 11th grader who's getting close to graduating. I'm not pulling my kid out of school. I'm going to let them finish high school remotely in New York, even if I did truly move somewhere else. So I think that's going to be interesting.
So
here's your site. I'm sorry. It's Phillips. It's a DTA 815489 April of 99, and Friedman is DTA 816142 March of 2000.
So what I was about to say is they're looking at all of the factors. So no one is determinative. And so you want to get things like the moving bill. You want to show maybe a change on the insurance policy, that anything that was valuable got placed on the new in the new location. The dog case is the case, an important case. The Match.com guy. Was that your case, Joe?
I litigated that one.
There you go. The dog case. If, where you bring your dog, that's key. And I think at the same time, he wrote an email that he's changing his domicile to Texas, even though it was only for a year and a half and he came back.
Karen, I remember, it's funny, that case to me has a lot of similarities to what I think people are going to be experiencing as a result of the pandemic. Those people who say, I got out of New York, but then are back 2 years later, a year and a half later. Well, those are the facts of the case that we litigated. But the problem is going to be then, if you're back a year and a half, 2.5 years later, can you really, satisfy your burden that you've changed your permanent home for a year and a half? That states, taxpayers don't generally do that, and states certainly look very skeptically on that type of fact pattern. I'll never forget, I was watching Monday Night Football, and it was a late game. It was near midnight, and I was sitting on my couch going through the emails, the evidence that we were going to put on, and I found this email that said, I'm bringing the dog back to Texas. Big D is Dallas is now my home. And the second I read that, I knew we won the case, because talk about intent, talk about mindset, that was perfect. But
that was great, and it was simultaneously written. That was great. That was simultaneously done.
Yep. And you know what, guys, you guys bring up a great point. Okay, with it, again, us that are pet owners, we may love our particular pet groomer, and maybe we are going back from Jersey all the way back into Queens for a particular pet, groomer and whatnot with it. But that's what the facts and circumstances of cases, with it. And again, I'll never forget the case of the guy who supposedly, and I'm sorry, I don't remember the name of the case, but it was a residency case. The guy was saying he was going to Connecticut, but New York State found out that he was still buying his fish at the local fish place, okay, with it. And they used that against him. Where the newspaper got delivered, right? The newspaper was still being delivered to his apartment that, and again, he kept the apartment, which was one of the problems, but his argument was, I don't really use the apartment that often, I'm on it, but anyway. But they actually looked at it and said, well, why would you read a paper 4 weeks after it was delivered to your house, right? But they looked at all his records and just said, your lifestyle didn't change. From the day you said you moved, every Friday, you're still going to the same place. Every Saturday, and nothing changed in your life, and we don't believe you, right? So it's just a fact and circumstances, and that's what people don't understand is that, if your pattern is still the same, then you really haven't changed, even though you changed your address on your driver's license, right?
So I want to address both of those points, because I've actually had those exact things in cases. So we once had somebody who did get the newspaper delivered to his New York City apartment, and what he said was, I own the garage in the basement, and the workers come up during lunch and read the newspaper. It's not me, it's somebody else. And when things are automatically charged on a credit card, it might be a false positive. It might be that on the 15th of every month, there's an automatic charge from, I don't know who, the newspaper or the cleaners or whatever, and it might not be that you're physically there. So you have to look for false positives. But it is a facts and circumstances thing, and it's very intensive. I always say it's like a colonoscopy. They're looking up your rear end with a microscope. That's really what it is.
Karen, I use that same example all the time of the colonoscopy, right? And here's the answer. Even though it comes back with great results, it's still going to be painful when everything is said and done. And that's what I tell clients all the time. It's going to be painful no matter what the results actually are.
So we have 10 questions. If we can go through them, let's see if we can get through them quickly. So someone is asking to explain the convenience rule again. I know she's in Connecticut, but I guess she means the New York rule.
Okay, go ahead.
No, go ahead.
No, go ahead.
So, the convenience rule is just about taxing income that is not earned, or taxing income in a jurisdiction where it isn't earned. So, John, you said she's in Connecticut?
This particular practitioner is in Connecticut, but I think she's asking about the New York rule.
So where this would be is if you have a Connecticut client, right? Your client lives in Connecticut, but your client works for New York, a New York employer, some company in New York. She's a commuter. She crosses the border every day. And what New York is going to say, if she decides, even before the pandemic, let's say the company has a policy that allows employees to work from home on Mondays and Fridays, long weekends. You don't have to come in. It's easy on the commute. You can work from home Mondays and Fridays. Well, those days worked from home for her from Connecticut are going to be subject to New York's convenience rule. And New York is going to say, even though you were actually performing services in Connecticut on Monday and Friday, we're going to treat those days as if you were working in the office, just like Tuesday through Thursday in New York. And New York's going to want tax on 5 days worth of income rather than just 3.
So isn't it the famous case, the Zielinski case? So he's a professor in New York State. He lives in Connecticut, and he grades papers from his bedroom in in Connecticut. And they said, it doesn't matter. You're taxed in New York. It doesn't matter that you're in your house grading papers. It's as if you were working in New York.
And some of these I can actually answer without bothering you. So I was just on one. All right, here's one. California employee moved in with her parents in Connecticut in March of 2020. She still works remotely. Her California lease didn't end until December. Part year for both states. Is she a resident? I think we need to look at the California domicile rules, but anybody want to comment?
So California is a little different than New York. I mean, look, ultimately when you're determining domicile, you're looking at the same factors, but California kind of sets it up a little different. California has what's called the temporary or transitory purpose test. The question is, were you in California for something other than a temporary or transitory purpose? If the answer is yes, then you're a California resident. And so the question is, at what point did she leave California with the intent to at what point in the year did she no longer have something other than a temporary or transitory purpose in California? It sounds like she can make an argument that when I left for Connecticut, I stopped being a California resident, even if my lease expired later in the year, because I was done. Now, again, it's a facts and circumstance. You're going to have to bring to bear all of the facts that we've been discussing here. The other thing that you have to worry about with California is California doesn't have the traditional 183-day rule. California instead sets up a presumption that says if you were in the state more than 9 months, not 183 days, that's basically half the year, but rather if you were in California for 9 months, then we're going to presume that you are a resident and you have to somehow overcome that presumption if you can. So it's a little bit of a different situation, but it sounds like in that scenario, assuming that everything left with her, despite the fact that she still had the employer back in California and that it was going to take a few months for her to give up the California rental, that she'll be able to make the argument that when I left California, I ceased being a California resident, in which case you're right that, that should be a part-year resident in each state. And again, that assumes that you're not above that 9-month presumption. It didn't happen in September.
And let me just add as a preparer now, okay, with it. Joe hit on a good point. Did she take everything with her? Okay, did she take everything with her? Or did she leave her car behind in the parking lot, okay, with it? Another very big question I would ask, and again, subject to all the things is, did she sublease her apartment that she couldn't go back? Okay, because if the apartment was empty, and she could go back, I would sit there and wonder about that. Now, maybe the lease says she can't sublet, and there's all kinds of things that we can talk about, the gray areas. But let's say that the lease did allow her to sublease, and she didn't. Okay, would you hold that against her? And I probably would hold that against her, that time and whatnot. So again, those are very, very important things to look at when you look at these cases. And again, as Joe said, facts and circumstances, there's not going to be a black and white answer for everyone. Everyone's going to be looked at, and we need to understand the circumstances. And regrettably, this particular person probably wants to hear that Connecticut is the answer and not California. And I think that we just have to look out there and tell our clients, listen, you pay me to tell you the truth, not lie to you, and go with it like that. And then some of them are going to be happy and some of them are not going to be happy.
And also you have to analyze whether it makes a difference. Because if you've got two states with comparable, state tax rates, you're going to do what's most expeditious and less risky for your client. Sometimes people don't realize that it costs them nothing one way or the other, or the difference is so small that it's not even worth the conversation. I mean, unless you're really patriotic and you're like, well, I live in New York and I want New York to get the money, or I live in Connecticut and I'd rather. Other than that, for a lot of people with comparable state tax rates, it doesn't make a difference.
Okay, so
But Sal, you're bringing up a good point, which is really relevant for the New York people. And that is, if you don't want to be, let's say, a statutory resident, there are some planning tips right there. So you could lease out your place, or if you want to change your domicile and you want to sell your house, you could give your keys over to the realtor and say, I'm not coming back. And those cases, there are cases or advisory opinions that say those things are acceptable. So for a permanent place of abode, you don't want it to be maintained for substantially all of the year, which is approximately 11 months. So you could lease it out for 3 months, or you could renovate it, and then it's not habitable. So there are ways to get around the permanent place of abode rules.
Yes.
And as we were saying, they look at everything, the credit card bills, the cell phone bills. And if you don't want New York State looking at that, the way to get around the 183-day count is not have a permanent place of abode. So we've had cases where somebody lived in Florida their entire life, went to school in Florida, got married in Florida, gave birth in Florida, was very active in Florida, and then bought a house in New York because their spouse was originally from New York. And when they sold their house in New York State said, wait a minute, we think you're domiciled here because you're you have a permanent place of abode, you had this New York home, and we want to see if you were here more than 183 days. And I came in and said, we're not even looking at day count. The couple got divorced. The guy was not able to come into the house. There was no unfettered use and access. He didn't have a key. He needed permission. And it's not deemed a permanent place of abode. And we're not giving you any of these records. We're not looking at that for 1 second. And New York agreed. Because actually, New York would have the burden of proof in that situation, because the burden of proof is on the person showing the change. So if you're in New York and you're looking to move out, you have the burden of proof. But if you're always out and you're looking to move in, or New York is claiming you moved in, they have the burden of proof. That's like the Jared Jeter case. He was always a Florida resident. He had a big apartment, $20 million apartment in Trump Tower, had all these endorsements in New York, and New York wanted to tax him. And there was a private settlement, an undisclosed settlement. We don't exactly know what happened, but New York State would have had the burden in that case.
And it goes down to the 7 Ps in any of this when you're planning, which is proper planning and preparation prevent piss poor performance. Like if you know that you want to do this, then you plan in advance instead of trying to fix things through the rear window.
Planning is the key, Shelley. Absolutely. And regrettably, for some of our clients, planning happens after they've done it, right? And they come in and ask to fix. Okay, we need you to fix this. And that's where the problem starts.
Because no one thinks that they're subject to New York tax. They think the rule is 6 months in a day. If I move to Florida and I'm there 6 months in a day, they think that's enough. They don't realize that there are other things they have to do.
Well, this is the issue with our clients in general. They sit there in February or March and keep staring at the paper and saying, there's something you have to be able to do about this, whatever that undesired result is. And the answer is, it's called planning, and we could have done it 6 months ago, but not today. They don't want to pay for the planning until they, want to retroactively do something.
And then they pay Joe and Karen to fix it. Absolutely. Love it.
I have to just say I'm very impressed with the accountants and of course, Joe, the attorney on this call. And I would love everyone's contact information before we get off.
So let's look at a couple of other folks, because so it's 3:40. Anybody that's staying on with us, if you've been on since the beginning and answered 6 of the 8 polling questions, you can go. You're going to get the 2 CE. I'm going to ask the panelists, do we have 5 more minutes maybe to bang out the rest of the questions?
No problem.
Sure.
Yes? No? Okay. So going back to some of the older ones. This one, let me ask this one. That's a Massachusetts one, which I think is an interesting one. A college, and some of these questions are not fully developed, sadly. What about college professors usually teaching in Massachusetts who are now teaching from home in New York State? Do they have, I guess the question is, do they have Massachusetts non-resident income? Because it's obvious that it's all taxable to New York either way.
I mean, if Massachusetts is the same convenience of, it's the employer convenience of employer test, and we talked a little bit about that, but Joe, yeah, you were going to say something. What do you think?
Yeah, I just wanted to clarify the facts. I'm sorry. This is a New York resident who normally teaches in Massachusetts, but is now teaching. So they commute to Massachusetts, and that now is teaching in New York because the college is shut down.
They must be teaching remotely. Yeah, it's not clear what, like I said, not fully developed. Yeah,
so I mean that is a pretty easy analysis, I think. They're a New York resident, so they pay tax on 100% of their worldwide income, but New York should give a resident credit to them for the tax that is paid to Massachusetts, and Massachusetts is going to expect all income that is earned both in Massachusetts and working remotely in New York to be taxed. So
based on their pandemic law. Yeah.
In this case, Shelley hit it on the head before. They're not going to pay really $1 more of tax. They're going to file a Massachusetts return, non-resident return. They're going to file a New York return with it. New York's going to credit what they paid Massachusetts, and only our bill is going to get bigger, which is going to upset them really a great deal. So there you go.
I mean, what would you say though if it was Massachusetts and New Hampshire now?
Well, there you got the fight. That's the fight. You know, New Hampshire. If you're living in New Hampshire, and working in New Hampshire for a Massachusetts employer, that's why the case is going to the Supreme Court.
Exactly.
Okay. Again, another one that's not fully developed. If client is Colorado resident, works in California, and makes Pennsylvania unemployment due to a Pennsylvania employer, I guess that's the only real question, because is what does Pennsylvania do with unemployment?
I don't think they tax unemployment, Pennsylvania.
Some states don't, like New York would, even if you're a New York non-resident, if you get New York unemployment because you worked here, New York taxes it. So I think that's something you need to look up. It's state specific. But I agree with Shelley. I don't think Pennsylvania taxes that.
And New York does. So if it was in New York was where they got the unemployment, that's New York source income.
Yep.
And unemployment is not taxed in Pennsylvania.
Oh, good. All right.
And you have to you should be taking withholding out of your unemployment in New York, as I mentioned earlier.
They only take 2.5%, and the New York State, and if it's state and city, it's 10 and over 10%. So I'm already seeing the shortfalls. And I mean, this is not a state issue, but John did share it in the COVID group the other day. But there is a proposed bill now about potentially not taxing the first $10,200 of unemployment income. So I'm not filing any returns yet with unemployment because I'd rather wait a little bit and see if this passes before we.
We're giving them the choice because I know the amended returns are going to be a wait. Okay, so
last question. One more. Who's got time?
I'm not going to. They keep adding. We're not going to add, but there were a bunch that were in early enough. Married couple. Again, not fully developed, but married couple lives and works in Illinois. They decide to move to Florida during the pandemic, and they're working remotely for the Illinois employer. They've changed things that don't matter, their driver's license, voting, mail, etc. Illinois should only tax the first 6 months that they lived in Illinois. Would we agree with that? And I think the answer is no, but I'll put that to the panel.
So the open question in my mind is whether or not they did in fact change their permanent residence to Florida. Right. If we assume that they changed their permanent residence to Florida, then I think that during the non-resident period, and especially if they're moving as a result of the pandemic or working remotely as a result of the pandemic, Illinois is one of the states that went the other way. You know how I listed those states that effectively adopted a convenience rule? Well, many states went the other way. And that's the problem, is that we have a mismatch of rules. Illinois is one of the states that went the other way and said, look, we're not going to source the work to where the employer is located. We're going to source the work to where the employee is actually performing it. So here, if it's actually performed in Florida and we agree that they're no longer a resident of Illinois, then I think that they would escape Illinois tax on the income that is earned while in Florida.
And Joe, you hit it on the head. Did they change their residency? That's going to be key. And if they kept everything the same, other than their driver's license and voter's registration, if the house is still there, all their valuables are still there, if the family pictures are still there, you're going to have an uphill battle on that. And that's what people don't understand about it with it. And that's the key. That's the key question. And you hit it on the head. Thank you.
I want to clarify, when I said polling questions before, there were attendance monitors because there's no IRS credit for this. So there were little beeps and you had to click the box. This is probably directed more towards Shelley and Sal. So what should a preparer have to do before starting to prepare the tax return? What kind of questions you have to ask? Do you need any documents from the employer for the complication with residency issues? Anybody have an idea what they're doing? Want to share?
One of the things that we did in my office is we sent out an email to all clients about, either we did or we're going to, I know we edited it, about the whole residency issue and what the rules are. And, just because you haven't been in New York, because, we have clients all over the country, but a big percentage are in New York City or New York State. So we went through what the rules were for New York, so that before they started all telling us that they didn't have to pay city taxes anymore, they had what the rules were and they could bring up the conversation. But I believe that we have to ask everyone where they spent the pandemic, how many days they were in different states, and have to determine based on each of those state rules what states require filing and what potential pitfalls the client can have.
I admit I did not send out an email or anything to my clients because whenever I send them a questionnaire, I get it back blank. So I decided that there was no point in doing it. So I plan to have conversations with clients when it comes up, and instead of opening up a Pandora's box, I have decided that I would deal with it on a case by case basis. With it, a lot of my clients are in New York and work from New York, so there's not going to be as many crazy circumstances of them leaving and going out. I mean, a couple of people, like Karen said, that have come up to the island, have stayed out to the island, including me, with it. But with that exception, I didn't have a lot of clients that thankfully left the New York border in any great sense. So I just decided to do it that way. And again, since my questionnaires go blank, and if you and John get questionnaires back that actually have answers on it, I like to know what you guys are doing different, other than maybe paying them to fill them out. But I get nothing back. So
we send them small bites. You don't send them a 7-page questionnaire or all these things. Just here's some basic questions. Then if you get yes answers, okay, now I need to know this. Keep it simple.
Yeah,
okay.
we tried that, and John, the answer is that it comes back blank.
Email. They all can do email and text.
Sorry, thank you.
One last one, and we'll get out of here. So if a New York resident works as an outside salesperson, they always use their home as their office. They move to Florida, buy a home in Florida, get a homestead rebate. That's like the New York Star program, right? They're declaring that they're a resident. But they maintain their home in New York. They keep the house and stay out of New York for more than 183 days. This is something that came up before. Can they be a Florida resident for tax purposes, income tax purposes? So they kept the key things. They moved to Florida. They're an independent contractor, moved to Florida, but lived there long enough to get the exemption on the homestead, but they continued to maintain the same house in New York.
John, did they keep their star credit?
I hope he dropped it. I wasn't going to ask.
I'm sorry.
Florida and New York can talk about that these days, so he'll find out soon enough.
Okay, with it.
Anyone have a thought?
Well, that's the problem with those questions is that, look, you don't have to give up your New York place to change your residence. Okay, there are many, just about any case law that you look at, those people have a New York residence, because if they didn't, there wouldn't be a case about
That's part of the problem, right?
Yeah, so all of the cases where taxpayers win, there's usually a New York residence. But the question is, did they do everything else? Did they pull all those different levers? You can still come back to New York quite a bit. If you tell me, Joe, my wife and kids are living or my husband and kids are living in Florida, going to school in Florida, would you spend a boatload of time in New York and still have a place in New York? I'm going to tell you, I'll take that case. I think you'll win that case because there's just so much weight to where your family is as a unit. Now you start muddying those waters and you say, well, the kids are in school down in Florida, but we spend all of our summers and vacations and everything else back in New York. You start muddying the waters a little bit. And unfortunately, it's just a facts and circumstance test. So look, you can keep the place and still win, but if you're keeping the place, you better make all the other factors that much clearer towards Florida.
And I'll even go so far, because we had a client who did this. They didn't take all the furniture because they said, why? I bought a new house. I'm going to get new furniture, right? But the key to it was the moving bill that showed them being moved, all the pictures and all the valuables and all the other stuff that got moved out of state. And I think it was Pennsylvania, if memory serves me correctly. That was the winning issue. It was that the furniture. No, they bought a new house. They got new furniture. The wife was not going to take the old furniture into a new house. Let's be serious. What wife would, right? But all the other stuff, all the valuables went. And then they, the pet going to the local pet groomer instead of going back to New York, I think was the key issue of getting that fixed and whatnot. So it's not as clear as, the moving bill, but what got moved. And thank God they called us ahead of time and we had pictures of everything being moved, of the crates, not the crates, the plastic bins, of the photograph, all of that being moved was the key part of all of that. And again, that's the difference between, paying Sal for an hour of his time as compared to coming in afterwards with a bill that said moved. That doesn't help very much, on it.
So I know you talk about pictures, but you talk about pictures, and that's key. We once had a woman who moved from the city to Long Island and bought a house, and we showed pictures of the kid's first birthday party on Long Island, and that's how we won the case. So certain basics are important.
And the picture writers, like on insurance policies, they'll look at where your valuables are because you tend to keep your valuables where your main home
is. Again, excellent point. And again, and again, Joe has said it now 1,000 times, and so has Karen. Facts and circumstances, right? You have to look at it with it. The problem is the client that asks you facts and circumstances, and then once they find out the right answers, they start modifying their answers with it, right? That's the other problem that Karen and Joe probably don't get, that me, Shelley, and John do get, right? Well, what's the right answer?
The truth is you end up losing credibility when you're dealing with New York State if you're changing answers. And they pick up on these things. Before we got involved in the case, they once interviewed the wife, and the wife said, oh, I'm not moving my kids out of middle school, until high school. That was before we got involved. Now when we say, oh, they had every intention of moving, New York State says, you just lost all credibility. Like they had no intention of moving. They were not taking their kids out of school.
So I do want to close this. I want to thank Shelley, Karen, Sal, Joe. I really appreciate it. Except for Sal, this is the first time all of you have been nice enough to come on one of our programs. So I appreciate it. I really do. And the big takeaway here, because I'm seeing other questions pop up, is there's no bright line test here unless the Billy Joel song, My Life, right? Sold the house, closed the shop, moved to the West Coast, right? That's the only bright line test, is you completely disconnected from New York and left. But otherwise, everyone, if you go back to the landing page, everyone's contact details are there. Happy to put you in touch. If not, call my office. We'll connect you with any of these professionals. And have a safe rest of the tax season. Anybody have a closing statement? John,
I want to thank you for this great opportunity. I was really impressed with your panel, and I really enjoyed all the questions and interacting with everybody. And it was clearly an engaged audience. They had amazing questions.
We did have over 230 register at the top. So, show up out of the 400 registered. So it was a good group.
Yeah.
Thank you, John. Thank you for inviting me. I greatly enjoyed it. Joe, Karen, nice. Shelley, it's always great to see you. Great being part of the panel. Thank you.
Likewise. Thanks very much, everybody.
Okay, everybody.
Thank you.
Thank you.
Okay.